So I think that we're all focused on just what's happened over the last couple of years. And if you look at a chart, like open your Bloomberg and look at a chart from year to date or the last 2 years, it does show softening trends in most of these barometers. It shows that inflation is down, thankfully, from very, very high levels. It shows that delinquencies are up a little bit. But then if you kind of take your fingers and squish that and zoom out all the way to, a 50-year time horizon, which a lot of this data encompasses, things today are actually kind of awesome. To use a technical term. And what I mean by that is we are at a delinquency level that's generally lower than where we've been in even normal cycles of the past. Financial obligations, same story. If you look at jobs, we're in a healthy level, but not super tight like we were coming out of COVID. So I kind of feel like there is this case to be made. And I know everybody hates the word Goldilocks, but we've talked about this before. I mean, everyone is so focused on what could go wrong, and I think it's because we've been trained by cataclysmic events that have happened in our careers. We've seen COVID, we've seen the global financial crisis, we've seen LTCM, Russia, Asia. We're all about crises and tail risks at this point, and that's our base case. I think the base case is something in between. I mean, if you look at the probability of a recession or stagflation actually happening, very low. 10% of the time or less we get stagflation or a meaningful slowdown. Most of the time we get some semblance of Goldilocks. So that's the view that we're espousing, is until things really start to fall off a cliff, until we see broad spread job losses, until we see the consumer really deteriorate on all of these measures, it's not necessarily time to throw out equities.